Hello, I'm Pat Cunningham and welcome to my second video explaining equity release. Today I'm going to talk about a very important point, which is compound interest and how it affects equity release. Please be kind enough to press the subscribe button underneath and feel free to make any comments you may wish, or press the like button or whatever. So compound interest. Albert Einstein described it as the eighth wonder of the world. What was it he said? He who understands compound interest earns it. He who doesn't pays it. So let's have a look and see what is compound interest. And the easiest way for me to explain it is by something called the rule of 72. So let's have a look at that. So let's have a look at the rule of 72. Rule of 72 says that if we divide 72 by the fixed rate of interest, it will give us the number of years in which that debt, that money, will double. Let's have a look at an example. We have a property valued at £250,000 and a 40% mortgage loan on that property of £100,000. In this example, we're going to use 4% as our fixed interest rate. So if we divide 72 by the 4%, it will give us 18 years in which that debt will double. So that in 18 years time, that £100,000 mortgage loan will in fact be 200,000 if we haven't made any payments and we've just allowed it to roll up. There's another example. It's the same property, 250,000, the same mortgage, but the difference is here we're going to use a 6% as a fixed interest rate. Now you may remember when we had high interest rates some years ago, 6, 7, 8% wasn't unusual. So you can see what happens now if we use 6% as the fixed interest rate. Divide 72 by the 6. It gives us 12 years. So in this instance, it will take 12 years for that debt to double. And we'll look at this shortly and see it again. And our third example, again, the same property, 250,000, the same mortgage, 100,000. But this time we're going to use 3% as our fixed interest rate, which is more relevant to the sort of interest rates we have now. In fact, we have a lot of interest rates up below 3%. So this is relevant to our time now in 2020. So when we look at this one, 72 divided by 3, it gives us 24 years. Now that's a big difference from what we saw in the previous two examples. It's now taken 24 years for that debt to double. So let's have a look now at some tables. Here we can see we have our property at 250,000, that's today, and our mortgage 100,000, of course without equity 150,000. Now we're going to use a figure of 2% as the annual capital growth which we would expect from the property. There's a reasonable figure to use, and here we're going to use 4% as the fixed mortgage rate. So when we look down now, we can see 5 years, 10, 15 years, 20, and in fact 25 years. And you can see how the property is going to increase in value over time using 2%. And here you can see the mortgage, how that is going to increase using the 4% fixed on a compound basis. When we look at the equity, you can see it remains fairly constant at about 150,000 all the way through, and in fact ends up here at 143,000. So more or less it's remaining constant, and that's using a 4%. Now on this example, we're using that 6% which we looked at before. Again, you can see it's exactly the same with the annual growth. It's the same figures at 2%, but here you'll see the difference with the 6%, how this is growing that much quicker. And you remember that when we divided 72 by 6, it came out at 12 years. So if we look 100,000, this is 10 years, this is 15, so just in the middle here you can see that would be about 12 years, and you can see there would be the 200,000. So it would double in 12 years at 200,000. And you can see in another 12 years down here, just at 24 years, just about here, it's doubled again from 200,000 up to 400,000. So here you can see that rule of 72 working, and this is what the mortgage debt is going to be using 6%. But now look at the equity. There's our original 150,000, and you can see how it in fact goes down every year until we get to this period here, which is the 25 years. Look, we've got a negative equity. This is where equity release has got a bad name, because people were paying these sort of interest rates, these high interest. So there you can see the difference between 4% and 6%. In our next example, which was the third example we looked at back at the rule of 72, again the growth exactly the same at 2%, but here we're using 3%, and you can see here where the mortgage goes up a lot slower. In fact, remember 72 divided by 3 was 24 years. So here we have today, this is 25 years, so 24 years is just about in there, and you can see that is where it would have doubled. 72 divided by 3, 24 years, that would be our mortgage, assuming it was allowed to roll up and we didn't make any payments at all. Now this is very appropriate because in fact we do have rates of 3%. In fact we have rates at the moment of under 3%. So you can see that now the equity is actually increasing through the term. And when we get round to 25 years, it's up at 200,000, so it's actually increased. This is only using a 2% annual growth. It's anyone's guess what the growth is going to be, but 2% is a very conservative figure. So here you can see how compound interest is affecting the equity in the property. And you can see how important it is to understand what happens with equity release. So there we are, that's the rule of 72. I hope it helped you to understand a little bit more about compound interest and how very important it is to understand as it relates to the equity of your property. Now, some people say, oh, it's interest on interest. You're paying interest on it. Well, I guess you are. If you don't pay any interest payments, then the interest will increase that capital sum. So each year, although the interest rate is fixed for the duration of the term, the interest amounts will be different every year. They will increase because you're not paying any interest payments. So yes, you'll be paying interest on the capital sum and the accrued interest as it comes along. So
there you see the effects in those tables that we saw of interest and what it does to the equity. So there is a way that you can alleviate some of those reductions in the equity. As we said in the last video, you've got a choice. You take a flexible plan with a lifetime mortgage, and you've got a choice whether you pay interest, either the whole amount or a partial amount. If you were to pay the interest, of course, there will be no reduction in your equity because you'd pay it off as you go, or a partial amount would reduce the effects. So make sure when you speak to your advisor when we're talking about equity release, make sure he explains to you the effects of compound interest and how it will affect your equity in your property over the years, so you can then be sure that you'll be able to leave a legacy if that's what you intend to do, and have a good idea of how much that might be. So make sure that you speak to them and you understand it. So I hope you're enjoying learning a little bit about compound interest. Please, as always, get in touch. You can look at my blog, which is underneath here now. Look at my blog. All those tables and the rule of 72 is all in the blog, so you can have a look at that again and go through that. Do the calculation yourself on the different interest rates and see how long it takes to double. Have a look at your own mortgage and see if it's been doing that, doubling up. Although of course you would have been paying a lot of that. If you've got a lifetime mortgage, have a look and see how long it would take. As always, you can also give me a telephone call. My number is here at the bottom. I'm only too pleased to call you back. You will get an answer phone message. Just leave me a message. I'll call you back, answer any questions that you have. I'll be delighted to do that. Leave any comments below if you wish. So that's about it on compound interest, except I hope we are dispelling myths as we go along here. So now for those naysayers and those people who love to leave negative comments and shout and scream, Mythbuster number 2. People who say, oh, you're paying interest on your own money. Well, you're not paying interest on your own money. You've still got your own money in the property. Your property is still yours. You are still getting capital growth on your money which is in the property. You're paying interest on a loan. The same as these naysayers are doing. They're taking loans out from the bank or from the builder societies or lenders, and they're paying interest. Exactly the same interest as you are paying. You're paying on the loan. You've got your money in the property. You've still got that. That's gaining capital growth. And you've got the same money to go off and spend as you like. So for that bit you've taken to go and spend, you're going to pay interest on it. It's natural. That's how it works. But you've got the choice of paying that interest or not. So you're not paying interest on your own money. You're paying interest on the loan, which is not your money. It's the bank's money who have loaned it to you. So there we are. That's another Mythbuster for you. That about wraps it up. If you've got any questions, please let me know. And the next video will be on how do you qualify for equity release? How do you qualify to get a lifetime mortgage? About your age and the properties and all the rest of it. So that's what will be coming on the next video. Thank you for watching. Hope you've enjoyed it. See you next time.